Welcome back to this channel for practice problems for actuarial exams. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. My advice on how to pass actuarial exams is at smarturl.it/pass. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to make a tax-deductible donation to support our students, please go to smarturl.it/help-ISU-actuary. This is a problem from the last fall 2017 exam MLC, problem number 17 in the multiple choice section. For a Type A universal life policy with a death benefit of $500,000, you were given that the account value at time 5 is $200,000. Premiums of $25,000 are paid annually at the beginning of each year. Expense charges are 2% of premium. The cost of insurance rate per thousand in year 6 is 30. The credited interest rate is the same as the interest rate used for discounting the value of the death benefit to the beginning of the year in the calculation of the account value. So the discounting rate used for death benefit calculation, IQ, is the same as the credited rate, I sub C, and it's 5%. The policy is subject to a corridor factor of 2.5. Calculate the additional death benefit for this policy at time 6. So recall that universal life with level total benefit and declining additional death benefit is what we mean when we say type A. In type B, it's the additional death benefit that is level, not the total benefit. And the standard recursive formula for type A is the account value in the next period is the previous account value plus premium after expenses. The R sub T plus 1 here refers to the expenses that are a percentage of premium, while E sub T plus 1 refers to the premiums that to the expenses that are just not percentage of premium but all the other ones. And then we subtract also the cost of insurance discounted to the beginning of the year, and COI refers to the cost of insurance rate, and that's multiplied by additional death benefit and discounted using the I sub Q rate to the beginning of the year. Remember, the death benefit is paid at the end of the year, assuming a discrete type of a structure of the payments, but that's what we assume here. All of this is accumulated with the credited rate. And in this case, without consideration for the corridor factor, now recall the corridor factor is this adjustment that may be necessary if the account value is so large that there is hardly any life insurance risk, and the tax laws require that if it's a life insurance policy, then the company offering it has to take some life insurance risk in it. So the amount of life insurance is to be sufficiently large in relation to the account value. 2.5 in this case means that the total benefit paid out has to be at least 2.5 times the account value. Well, we do the calculation first without any consideration for the corridor factor and see what happens. And if it turns out that the death benefit of 500,000 is too small in relation to 2.5 times the account value, then we will have to make an adjustment. So we plug in the numbers. The previous account value was 200,000. The premium is 25,000. After expenses is 25,000 times 0.98, and then the cost of insurance rate is 30 per thousand times 500,000 minus the account value. That's the additional death benefit. All of this discounted at the rate I sub Q, which was 5%. And then the entire quantity is accumulated at 5%, which is the credited rate. Well, as you can see, this is an equation in which only AV6 is unknown. Everything else is known. And we solve it for AV6, and we obtain 227,551.55, 227,551.55. But the policy is subject to a corridor factor of 2.5. This means that the death benefit will be the greater of the specified amount of 500,000 and the account value at the end of the period times the corridor factor. The account value calculated multiplied by the corridor factor gives 568,878.87. Well, this means that on this first provisionary calculation of the account value, we actually get a corridor factor that applies, because a corridor factor times the account value exceeds 500,000. And that means that we have to redo the calculation now, assuming that the corridor factor applies. So now we do this. And the additional death benefit is now 2.5 times the account value times 6 minus account value times 6, which of course is just 1.5 times the account value times 6. But otherwise it's the same what we had before. From this, account value times 6 is 200,000 plus 25,000 times 0.98, the whole quantity times 1.05 minus 0.03 times 1.05 AV6, so that AV6 can be calculated. It's the only unknown in this expression, and it's 200,000 plus 25,000 times 0.98, the whole expression now multiplied by 1.06 and divided by 1.045. That comes out to be 225,574.16. And the additional death benefit, the question asks for the additional death benefit, is, well, how much? It's the excess of the death benefit paid over the account value. But because the corridor factor, that's just applies, that's just 2.5 AV6 minus AV6, so it's 1.5 times AV6, so 1.5 times what we just calculated, and this is 338,361.24, which is answer E. Please remember this is copyrighted material. The problem itself comes from Society of Actuaries and belongs to the Society of Actuaries. The solution is mine. All rights reserved. Well, good luck in your studies and good luck on the test.